Look, I know this might surprise you. I'm about to reveal 3 stocks that I will never sell from my portfolio. And yes, that's coming from someone who's always talking about active trading and market timing. Truth is, while I still believe most investors struggle with pure buy and hold, I've carefully selected 10 specific companies that I'm holding forever. Today, I'm sharing the 3 most interesting ones. These forever holdings make up about 20% of my total stock portfolio, and that's not by accident. I've structured it this way to balance growth potential with safety. The rest of my money is split between active trading and broad market ETFs. Here's what's interesting. I started with smaller positions in these companies, but some have grown significantly because they've performed so well. Even though I actively trade other stocks, including sometimes these same companies in separate accounts, these core positions stay untouched. This strategy gives me the best of both worlds. I can be aggressive with my trading while knowing I've got rock-solid long-term holdings as my foundation. Think of it as an insurance policy against being completely wrong in my trading decisions. When I say diversification, I'm not just checking boxes. My forever portfolio includes companies from tech, finance, oil, and consumer goods. Each of these sectors responds differently to market changes. When tech is struggling, maybe oil is booming. When finance is down, consumer goods might be hitting new highs. This isn't just random picking, it's strategic positioning. And the 3 companies I'm about to show you are perfect examples of this approach. Each one has a completely different business model and serves a different purpose in my portfolio. First up is McDonald's, but not for the reason you might think. While everyone sees a fast food chain, I see one of the smartest real estate plays in history. Here's the genius part. McDonald's owns most of the land and buildings where their restaurants operate. They're essentially a real estate company that collects rent from franchisees. And not just any rent. They charge way above market rates because these locations are proven money makers. Think about it. Even if fast food trends change completely, McDonald's still owns prime real estate in some of the best locations across the globe. They could literally put any business in these spots and still make money. This is exactly why McDonald's keeps hitting all-time highs. It's not just about selling burgers. It's about owning valuable real estate that generates consistent cash flow. And that's why it's a forever hold for me. Next up is Berkshire Hathaway. And before you say, boring, hear me out. Instead of buying an S&P 500 ETF, I'd rather own Berkshire's B shares. Why? Because you're getting way more than just a market index. Think of it as a super ETF that owns both public and private companies. Here's what most people miss. While everyone knows about their Apple and Coca-Cola holdings, Berkshire owns entire companies that print money in boring but profitable industries. From insurance to candy, from house manufacturing to cowboy boots. And right now, they're sitting on nearly $300 billion in cash, waiting to buy more great businesses. Sure, Warren Buffett won't be around forever, but the company's built to last. They run one of the world's largest businesses with fewer than 50 employees at headquarters. Talk about efficiency. And here's a bonus prediction. Once Buffett's gone, I believe Berkshire might finally start paying dividends, which could be huge for long-term holders. My third forever hold might surprise you. It's Tesla. Now, before you jump to conclusions about Elon Musk or valuation metrics, let me explain. Tesla isn't just a car company. It's a bet on the future of multiple industries. While everyone focuses on electric vehicles, Tesla is quietly building an energy empire. They're leading in battery technology, solar power, and AI development. Yes, the stock is volatile, and yes, Elon Musk can be controversial. But here's what matters. Tesla consistently proves the skeptics wrong and keeps pushing technological boundaries. I've sized this position appropriately, given the higher risk, but I'm convinced that in 20 years, we'll look back at today's Tesla price as a bargain. So, when would I actually sell these positions? The answer isn't about quarterly earnings or short-term price movements. I'll only sell if there's a fundamental change in what made me buy these companies in the first place. For McDonald's, that would mean losing their real estate advantage. For Berkshire, it would be a complete shift away from their proven business model. And for Tesla, it would be if they stop innovating or lose their competitive edge in EV technology. But speaking of fundamental changes, this ties perfectly into what I discussed in my last video about Larry Fink's warning. If you haven't seen it yet, BlackRock's CEO just dropped some bombshell insights about how the market is completely misreading interest rates. This directly affects companies like McDonald's with their real estate exposure and Berkshire's massive cash position. You'll want to check out that analysis right after this. I'll link it in the description below and in the card above.